My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. I can't believe it, but this is the year mark, I guess you could say, of this series. This is the 20th video that we've done in this series, and I've just been kind of looking back through my old videos. I've been on YouTube for about 2 years now, and when I first started, I would maybe get a couple hundred people, maybe a couple dozen people watching the videos. And I will admit the quality of my first videos were not great. In fact, they were pretty cringy. But you kind of got to start somewhere. When I first created this channel, I thought to myself, well, what's the point? There's so many other finance channels out there or personal finance. Why should anybody watch me, or what's the point, right? And I think about that with my dividend investing experience here, with the market at all-time highs, with inflation soaring, right? What's the point? Why start? Why even bother? And I kind of thought to myself, well, if I never started, I would have never gotten to where I am today. If you never start something, you're never going to improve your life. I kind of think of it as if you've ever struggled with eating healthy or exercising, getting into a healthy routine, going to bed on time, right? If you don't start today, tomorrow you're going to be faced with the same challenges, right? If you don't exercise today, okay, you're going to be in the same state a week from now, a month from now, a year from now. So it's the same thing with investing. If you don't start today, then you're going to be in the same situation that you're in next year. And when I look at the progress of the channel here on YouTube, I kind of look at it that way. When I first started, I had no idea what the hell I was doing. I was just kind of, talking about dividend stocks and throwing out my opinions and ideas. And I'm so glad that I've stuck with it because, we have such a strong, great community here on YouTube. There's thousands of you that follow the channel. I know not all of you comment on the videos, but I know a lot of you are getting a lot of value from the channel. And I just want to say, that's why I created this channel in the first place. So thank you so much. It is really crazy to me to think that it's already been a year that we've been doing this Review My Pie series. And I think back, okay, where was I at a year ago? And I think back, oh yeah, this was what was going on a year ago.
Hello boys, find everything you need?
Yep, all set.
Okay, let's see here. Toilet paper? Toilet paper? Toilet paper. Toilet paper?
I just want one pack.
But thank goodness things are so much better today. Oh man, I don't even need to watch comedies anymore. I just turn on the news and that's where I get all my entertainment. All right, in today's Review My Pie, we're going to review 4 subscriber portfolios. The first portfolio is going to be from an 18-year-old here in the United States. The second, a 22-year-old here in the US. The third, a 27-year-old from Germany, where I used to live for about 10 years. And then the fourth, a 63-year-old here from the United States. As always, the timestamps are in the description. If there's a portfolio link, it's in the description as well. And as always, everybody, I'm just a random dude. I'm not a financial advisor. Don't take what I'm saying as professional financial advice. It's just merely for your entertainment. All right, the first portfolio is from Sebastian. He writes, "Hi Jake, I hope you're doing well. I recently found your channel about 2 months ago, and I've seen a lot of your videos and I've learned a lot about investing, especially dividend investing. I was wondering if you could look at my portfolio and if there's any advice you have for me. I'm 18 and living at home with my parents. I got a job as soon as I turned 18 and I'm able to put $100 into the market every week. My goal is to hopefully retire when I'm 45 and live off the dividends. I was on Robinhood, but recently transferred over onto M1 Finance because I really like the ability to set up my percentages and have their system work out how much of my deposits go into each company. I would really appreciate it because I want to have the best start possible. Keep up your videos. They bring a lot of inspiration." All right. Thank you so much, Sebastian. This is awesome. So you're 18 years old. You're already investing. I think this is amazing. I wish I would have started investing when I was 18 years old. The challenge that I ran into, and I shared this a little bit on my last video, I've been investing for over 15 years, but I never really stuck with one strategy. I would try one thing one year, I would try another thing another year, and I never really stuck with it. And therefore, the power of compounding, I never really got to benefit from compound interest because I was always changing my strategy. So that's the very, very first thing. The earlier earlier you can focus on your strategy, and it's okay to change things, like things in our lives change, but really to take advantage of compound interest, you really want to focus on that and not always look at changing your portfolio. So that's the very first thing that I would say. Transfer it over to M1 Finance compared to Robinhood. I think it's a great idea. The big reason why I also transferred from Robinhood to M1 Finance 2 years ago was exactly because of that. The automation, setting up your automatic transfers, and that it was focused on the portfolio as a whole and not just on the individual stocks. So very much hands off, with M1 Finance compared to Robinhood or your other traditional brokerages. At least that's been my experience. Now, before we dive into your portfolio, there is one thing that I want to say. Because you're looking to retire before the age of 59 and a half, you have to think differently about your investment accounts. Not only is it important to pick the right investments, but also which type of accounts. Because here in the US, we have tax sheltered accounts like a 401k, a Roth IRA, an IRA, HSA. All of these accounts are great. I kind of look at them as vehicles to help you get to where you want. But if you want to retire at 45, you have to look at this at a little bit of a different angle. What I would recommend you do after you've watched this video, go to my channel and watch this video on taxes. One of the biggest challenges with retiring early, at least a lot of the questions that I get here on the channel is, well, what about taxes? What about that? What I would recommend you do is go ahead and watch this video, how to pay zero taxes on your dividend income in early retirement. This video, I go into detail about how you're going to pay zero taxes when if you were to retire early off of dividend investing. It's very different than what most people think. All right, Sebastian, let's take a look at your portfolio. You're up 149% over the last 5 years, not considering the reinvestment of dividends. So it's actually higher than this, especially with a 3% dividend yield. This portfolio is actually performing very well. You have a low expense ratio, so that means you have some ETFs in here. You have a very manageable amount of holdings. 32 is a really good number in my opinion. So let's take a look. You got 8 slices. Consumers at the highest. Now this could be consumer staple, discretionary, non-discretionary. They're very different. So if you're going for staples or non-discretionary, these are more defensive stocks. They do better in economic downturns, but they don't perform as well in economic booms, right? So there's very big difference between defensive and non-defensive. Technology, 20%, great. Real estate, 16, yeah, fine. Healthcare, 15, finance, 8. You got some energies and utilities. You also have SPHD, and you got telecom. Okay, so right off the bat here, without even looking at the individual holdings, if you're 18, you're looking to retire at 45, so you got about 25 years. The dividend yield is a little bit high for a 25-year time horizon. I think, for 25 years, yeah, you want between, I would say between 2 and 3. I would not go over a 3% dividend yield. I would optimize the portfolio so that it's below 3%. The challenge here is you are going to have that tax burden with the dividends. Yes, it'll be a little bit slower than, building a growth portfolio and then selling it all at once. But you have to understand for the next 25 years, you will be paying taxes on this. So you want to make sure that you're optimizing the taxes here. So for example, with real estate, you're taxed at ordinary income rates compared to your qualified rate, which are your long-term capital gains rate, which is generally lower. So something that you could consider, especially right now while you're really young and you're looking to optimize your portfolio, something that you could consider is lowering real estate temporarily, for the next 10 years, temporarily 10 years, yeah. And then once you get closer to retirement or early retirement, then you can increase your exposure to real estate. Nobody on YouTube really talks about that. That is exactly what I'm doing in my portfolio. I have my cash flow portfolio. I also have a real estate portfolio. My real estate portfolio is off on the, on the side. Once I get closer to retirement, that's when I will start funding my real estate portfolio because it is in a taxable account. So something to consider. Let's take a look at your first slice. In your first slice, you got 11 holdings. You got your Pepsi, McDonald's, Nike, you got your Walmart, Walgreens, Kimberly-Clark, Ultra Group, Procter & Gamble, Home Depot. 3M's an industrial, but that's fine. Coca-Cola. Okay, I like that you have Coca-Cola down here. I like you have Procter & Gamble down here. Where's Costco? Where's Costco? Costco is a great staple. Where is your McCormick, right? These companies with massive growth. Like McCormick is a great long-term dividend growth company. I love that you have McDonald's in here. I like Nike. I like Pepsi. Kimberly-Clark is great. What I would maybe consider doing, you have 25 years, right? Why not lower these other companies like Pepsi, Ultra Group, Kimberly-Clark, Walgreens down to maybe 5%? Maybe something to consider, and then bump up your Walmart, your Nike, your McDonald's. And then as you get closer to retirement, this is not something that you review on a monthly basis, right? You review this maybe on a yearly basis. So maybe every year you kind of check in and see, okay, how's everything going? And then you can maybe adjust it. But with this portfolio, you want to stay hands off. And maybe in 5 years, then you update it. Then you increase Coca-Cola. Then you increase, your PepsiCo. But that's something that I would highly recommend you and anyone watching this video do when you have a longer time horizon. And that's why M1 Finance is so great, because all you have to do is go in the edit, update the percentages, and then M1 Finance does it for you. So that's what I would highly recommend you consider doing. Now let's take a look at your technology. You got Microsoft, Apple, Texas Instruments. Yeah, I think this is fine. I like that you have Microsoft and Apple at a higher allocation. You got Texas Instruments down here to lower. This is exactly how you should do it when looking at this for asset allocation, target allocation here. So that's great. I think that it's me personally over the next 25 years, like, I work in technology. I work in the tech sector. There's disruption happening all the time. I mean, these are 3 really, really great companies, but that is a lot of exposure to tech. So let's take a look at this. Let's see here, for example. So you got 0.40 times 0.20. That means 8% of your overall portfolio is in Microsoft and another 8% is in Apple. What I would encourage you to do is try to make it so that not one single company is over 5%. That's how you diversify. That's how you keep your exposure down. So you make sure that, at least in my opinion, I don't have any individual holding except for ETFs. Individual companies make up over 5% of my overall portfolio, and I try to keep one sector under 20%. So I don't want too much exposure. With you though, you have defensive and non-defensives in this consumer slice, so I think you're okay with 23. But those are some of the guidelines that I live by. Real estate, what do you got in here? You got Realty Income, you got Stag, LTC, and you got Dynex. Okay. Yeah, these are great, but once again, 25-year time horizon, I would encourage you to look at more growth-oriented ones. I love Stag in here. You could look at Prologis, ticker symbol PLD. It's a really, really growth industrial REIT, one of my favorite REITs, in fact. You could take a look at Cell Towers. You could look at Digital Realty Trust, ticker symbol DLR. Once again, if you've been following this series, I always talk about the same thing. The best growth sectors in REITs, in my opinion, are industrials, cell towers, and data centers. Those are the best. Those are the fastest growing. Just like in your other sectors like telecom and utilities, real estate is functioning the same way in terms of growth and value. All right, let's take a look at your healthcare. You got Johnson & Johnson, AbbVie, and Pfizer. This is amazing. I really, really like this. I own all 3 of these holdings in my portfolio. You could look at other growth ones like Stryker or Medtronics. Those are also really great healthcare companies. All right, let's look at your finance. Finance is up over 200%. You got your Visa, JP Morgan, and Aflac. Yeah, this is great. If you wanted to look at other growth ones, you could look at Standard & Poor's, ticker SPGI. You could look at T. Rowe, but as it stands here, it's absolutely fine. Energy and utility, NextEra Energy, love it. ExxonMobil, do not love it. In my opinion, this should be your lowest holding. Southern Company, really like it. Waste management, obviously I love waste management. I just love garbage. I don't know why. It's just garbage is amazing. Duke is great. So all of these are really, really good. You got energy and utilities. So waste management's an industrial, but with Exxon, me personally, man, I don't know. It's fine. Like, I don't think they're going anywhere anytime soon, but for your time horizon, I personally would prefer, focusing on next year energy. And if you're going to have waste management in this slice, bumping up waste management. So it's my opinion. SPHD is fine. It's a good monthly dividend payer. It has a bit of a higher expense ratio. The companies in this ETF are fine. They're not the best in the world, but they're not the worst in the world either. That's my opinion on SPHD. Telecom, what you got in telecom? You got Verizon and you got AT&T. Okay, so what I would consider is maybe looking at Comcast, adding Comcast. You don't have Disney in here. Disney is a great one. You could put it in telecom as well, right? You could go in consumer, officially, I guess. But I would look at either maybe lowering telecom or adding Comcast in there. And that's really the thing is like AT&T and Verizon, they're some of my largest holdings. But my time horizon is less than 5 years. Your time horizon is 25 years. You see the picture here? You want to focus, especially if you're going to retire before the age of 59 and a half, you want to focus on your time horizon and you want to skew more towards growth the longer that you have, the longer time horizon you have. Remember what I was talking about with compounding interest? With compounding, you want to focus on growth because growth will compound faster than value, right? And this is more of a value play. Same with the Exxon. All right, so Sebastian, thank you so much for sending over your portfolio. I think you have the fundamentals that you need to build out your portfolio. It's just a few of those things that I was talking about, focusing on the target allocation, especially with optimizing for tax efficiency and the growth. Like if you were looking to retire in the next 10 years, I would say don't change a thing. Like this is great, but 25 years down the road is a long time. You could easily get this up to 200, 250. Historically, obviously, if you focus more on growth. Thank you again, Sebastian, for sending over your portfolio. All right, the next portfolio is from Andres and also known as Wasby22 in the comments. Thank you so much, Wasby. Every single week, man, you're commenting on my videos. Thank you so much. I really, really appreciate it. I always get so excited when I see your comments, honestly. So, all right, so you right here, hey, my name is Andres. I'm an avid watcher of your YouTube channel, also in Texas like you. Shout out from Austin here. You continue writing here, currently 22 years old and have a part-time job and part-time school. I invest in quite heavily into growth-oriented things, which I know you personally don't like timing the market, but I hope to try. Anyways, this is a portfolio. If you review, I'd greatly appreciate it. All right, Andres, let's take a look at your portfolio. You're up over 400%. Look at these massive spikes. You've had a lot of volatility I can see here in the last couple of weeks. I bet your portfolio dropped 15, 20% these last couple of weeks. But you're also up 400% if you've been investing in this for the last 4 years or 5 years. So let's take a look at it. You have a healthy expense ratio, a healthy dividend yield. It really comes down to, so Andres, it comes down to, if you've been following my channel, which you have, you understand that it's based off of your time horizon and you can invest in growth. In some cases, if you time it right, like the reason why I don't like investing just into growth is you're trying to time the market and hope that the price goes up and that you sell at the right time so that you can then reposition into maybe dividend stocks. This approach can work very, very well if you have a longer time horizon. If you have less than like 3 years, I think it's very, very difficult. And, that's just kind of my opinion there. And it plays a role based off of which account, if it's a tax sheltered account or not. That's kind of my thoughts there. All right, so let's take a look at what you have in here. You have 4 slices. You got the largest in the momentum ETF here. What's this yielding? Okay, this is fine. It has an okay expense ratio. The one that I like is for a growth ETF, I like VGT from Vanguard, the technology ETF. That's my favorite growth ETF, VGT. I also like SPYG. It's another good growth one. But let's see here. You got Tesla in here and you got SCHD. Okay, yeah, that's fine. I mean, Tesla, I think they're doing so many interesting things. So DGRO, let's see what you have in this slice. DGRO is the dividend growth. Okay, there's also an ETF DGRO. But let's see here. You got 35 holdings. Yeah, it looks like they're all equally weighted. Let's see what you got here. You got Visa, you got Stryker, amazing. You got United Healthcare, you got Union Pacific. Union Pacific just increased their dividend by 10%. A railroad increasing their dividend by 10% is amazing. Look at this, right? It has a healthy dividend. It's beating the S&P 500 and it's increasing its dividend by 10% a year. Great dividend growth company. Texas Instruments, you got Target, Taiwan Semiconductor, T-Rowe, Roper. Okay, Roper, cool. MasterCard, Lululemon, Old Dominion, NVIDIA. Okay, you got some Nike. All right, cool, great. Broadcom, Costco, Crown Castle, Abbott. Man, I've been buying Similac formula, baby formula the last couple of weeks. Man, I was thinking about even investing into them, you know, considering how much we're spending in baby formula. So really, really great company. Microsoft, Apple, BlackRock, AMT, SPGI. So yeah, you definitely been following the channel, man. SPGI, you got Stryker up there as well. This is great. So I like your portfolio. There's a lot of great brands in here. A lot of great names. I think the thing that I would tell you, Andres, is if you don't understand how these companies generate revenue, despite having the best fundamentals, the best track record, I would encourage you to maybe reconsider having them in your portfolio. You're still young. You do a revamp of your portfolio and you're thinking, okay, do I really want to have this company in here? The big thing when having this many, the variety that you have in here, the overall number is great. But what I would encourage you to do is, if you don't know how NextEra Energy generates their revenue, you should ask the question, do you really need them in your portfolio? Or do you really know how Abbott, what their competitive landscape is, how they compare to other pharmaceuticals in their industry, or BlackRock, or et cetera, right? So that's the question that I would ask for you. All of these companies are so great. They're great companies. But for you as an individual investor, ask the question, do you know what these companies do for, to generate revenue? Do you understand their competitors? Are they going to be around? Are they still going to be competitive in 20 years? Now, obviously nobody has a crystal ball, but those are the kind of questions that you should be asking yourself, and it'll help you either reassure that you're making the right decision, or if you have any question or doubt, then maybe you need to reassess having one or two of the other holdings in here. But yeah, that's what I would recommend you do. Everyone do. It's something that I do myself. Once again, Andres, thank you so much for sending over your portfolio. And as always, I always look forward to reading your comments. The next portfolio here is from Richard from Germany. He writes, "Hi Jake, I'm 27-year-old young investor from Germany and have a very unique portfolio I want to share. For this strategy, I created a second portfolio, but I have a lot invested into Qualcomm, Microsoft, and German stocks in my other one. That's why they are underrepresented in this portfolio. My goal of this portfolio is to create a passive stream of income that would cover my rent. After achieving this, I would start another account with a different strategy and I only reinvest my dividend in this one. During the time I build up the last portfolio, this one should take care of itself, so the dividend income should be truly passive. But in order to feel comfortable with an unintended portfolio, the exposure to each stock should be less than 1%, so this intended to be over diversified." Okay, wow. The goal is to create something similar to an ETF, but I'm in control of the dividend yields, dividend growth, sector, and every other aspect of it. That is very true. A lot more manual work, but it can work very well. I would see myself as a value investor that uses the PE, price to earning, as a measurement, but not as a determining factor. So I'm willing to buy TMO with a 38 PE ratio because they are a 10 out of 10 stock with a stable growth, low payout ratio of 5%. Ooh, that's a really good payout ratio of 5%. Low volatility and low debt. There are a lot of smaller, less known companies in my portfolio, and I have a different reason for each stock. So if you want, we can arrange a call via Discord, Zoom, or Skype if you want. Because I live in Germany, I pay the same tax rate on REITs as on common stock and have no double taxation in the US or Japan. That's really good. I contribute at least $500 from my paycheck to this portfolio, $170 from dividends from my other portfolio. Greetings from Germany, Richard. Well, Richard, thank you so much, man. This is really, really interesting. I like the fact that you're thinking about it in terms, from a value-oriented perspective, diversification, also country diversification. You're even thinking about the payout ratio. The payout ratio is so important because that's really your risk factor on whether or not a company, when they're hit with a tough time, like say, for example, a pandemic, and their cash flow, their revenue drops, are they going to be forced to cut their dividend? All right, Richard, let's take a look at your portfolio. I know you mentioned in your email that this is a unique approach, and I think you're right. I think most people should not approach their dividend investing strategy in this way. I think most people would get overwhelmed with this. I think maybe 5% of the viewers watching the channel, this would maybe be applicable for. But let's take a look and see how you view dividend investing and from your perspective. So let's take a look and see the different type of companies that you have in here. And let's see if we can put together kind of like an analysis of what you got going here. So you got Tractor Supply Company. This is a great company. This is a great recession-proof company. You got JP Morgan. So you have a good balance between different sectors. You got energy stocks in here. You got financials. You got consumer discretionary. You got you have some technology companies in here. You have some REITs in here. It looks like you even have some ETFs. You have Tyson Foods, for example. You got Leggett and Platt, Pfizer, Realty Income. So really, really good dividend paying companies. All of these companies, like I'd say 90% of them, I'm very, very familiar with, right? You got some, you got SAP, you got Oracle, you got Stag, you got Public Storage, NVIDIA. We're down into the 100. You got Iron Mountain. Okay. Yeah, now the fact that you have Iron Mountain in here, this is something that I kind of like, where, Iron Mountain, it's pretty risky, right? It's a high dividend. Their business model is in question, if it's sustainable, if they're going to continue to grow, with the shift towards digital, and they're going to have to shift their strategy a bit. But you don't have all the risk. You can invest in this individual company, so you have an opportunity risk, right? Where if you were to invest more into Microsoft, you'd have likely a higher return. But this is really, really interesting. I think it's so interesting to see how you pick these different companies. You got Kellogg's in here. I have Kellogg's in my portfolio. You got 3M. You got Welltower in here. It's a great healthcare REIT. You got Southern Company. Yeah, you have a lot of really, really great companies in here. Let's see if we can zoom out of here and you can see a little bit more. Okay, so there's a lot of companies. I think you had, over 160 companies in here. Once again, I wouldn't recommend this for everybody, but I think this just goes to show how many great dividend companies there are. Well, Richard, thank you so much for sending over your portfolio. As living in Germany for 10 years, I know that Germans are very, very great when it comes to engineering. Hopefully, when we're thinking about engineering and improving things, sometimes we can get a little bit too into the weeds and over engineering in some cases. But what I would encourage you to do is, think about, okay, is this sustainable? Can you realistically follow up with this over the long term? Right now, you have the time, the energy, but think about in 10 years or in 5 years, right? Maybe you have a family, maybe you have a stressful job or whatever. Maybe your priorities shift. You might see yourself buying and selling more from this portfolio. And that's what I mentioned earlier in the video. You want to focus on consistency so that your portfolio can compound. And if you're constantly buying in and out of companies or changing your portfolio, that compounding can maybe can deteriorate a little bit. So thank you again so much for sending over your portfolio. It's definitely interesting to see how different people are investing in different parts of the world. All right, the last portfolio is from Riz. He writes, "Hi, I am 63 years old and started investing around October 2019. A little late, I know. With the exception of 200 shares of Sirius years ago when Howard Stern went there. Other than that, I am new to investing community. I plan on retiring a couple of years and would like to have at least $1,000 per month in dividends. I'm currently putting $250 per week and investing the same amount per week. I usually choose and pick which stocks to invest in. We're open to closing some and putting more into others if that is something you think would be more beneficial, with the exception of Neo, Tesla, and Beyond Meat. Thanks for reviewing our account. Well, Riz, thank you so much for sending your portfolio. It is so cool to hear that, a 63-year-old is following the channel and looking to grow passive income through dividend investing. Okay, the very first thing that I would say, because you're 63, investing in the right account type is the very first thing that I hope that you are optimizing. The portfolio that you're sharing, I hope it is in a tax sheltered account like a Roth IRA or a regular IRA, one or the other. Because you definitely want to make sure that you're taking advantage of those tax advantaged accounts. Because you're 63 years old, you likely have a much shorter time horizon than maybe somebody that is 18 or 22 years old. So you're looking really ideally for companies that are going to start yielding a higher return today. All right, Riz, let's take a look at your portfolio. So it doesn't look like the chart is going to be showing something. It looks like you may have an IPO company, a company that just went IPO. Sometimes M1 Finance doesn't show the historical data if you have a company in here that just recently went IPO. But we can look at the overall stats here. You got 56 holdings, you have a little over a 1% dividend yield, and you have an expense ratio. So it looks like you're taking a mixed approach of growth and dividends. Okay, so for me personally, I like to separate these accounts. I like to have two different accounts. I like to have a growth account and I like to have a dividend account because it just kind of helps me to focus on, what I'm doing, right? Do I have, is my strategy this or my strategy that? With M1 Finance, you can actually have two separate accounts. You can create two accounts with the same login. So that's something that I would recommend maybe checking out and seeing if that's the right approach for you as well. So as I mentioned earlier, because you're looking to likely live off the dividends much earlier than maybe an 18-year-old, you want to focus on the current yield, the dividend yield. Okay, so I'm going to look at it from that perspective. All right, so Riz, you have just about a 2% dividend yield in this portfolio. Now, this is something that I would encourage you to really think about. Are you looking for cash flow or are you looking for appreciation? Because they're very different. It's difficult to get both with your time horizon. With your time horizon, you're probably looking to leverage the dividend in the next couple of years. It's really focusing, okay, is it capital appreciation? Are you looking to buy low and sell high? Or are you looking for the cash flow from the dividend? Okay, and so once you've come up with that answer, okay, hey Jake, I want to focus on the dividend with this portfolio. And the other portfolio, I want to focus on the capital appreciation. Those are two clear strategies, and it's difficult. You kind of muddy the waters if you try to do both. And that's why I'm recommending this or suggesting this. So with Qualcomm, Disney, Microsoft, and Apple, are these capital appreciation stocks or are these cash flow stocks? In my opinion, with a short time horizon, these are not specifically Disney and Apple and Microsoft. These are not cash flow plays. These are appreciation plays, right? So you buy them low, you sell them high, and then you reposition into a company like Store Capital or Coca-Cola. So that's my opinion there. Kellogg is a great one. For your time horizon, which is likely less than 5 years, I would focus on companies that pay at least a 3.5 dividend yield, ideally a 4% if you can get them. Like my favorite, some really good 4% dividend yields are AbbVie, for example. There's some really good REITs. We talked about having this maybe in a tax sheltered account. You could go heavy on REITs, right? You could get healthcare REITs. You can get diversified REITs that yield 4, 5, 6, even 7%. So that's my opinion. With a tax sheltered account, you have a little bit more flexibility, but definitely, answering that question, growth, appreciation, or cash flow. Now let's look in your technology. You got your Neos, Teslas, Squares. So this for me is, obviously this is a clear growth play. This is a growth play that, you're hoping in the next couple of years that it appreciates and that you can transition out of this and then maybe move into dividend stocks. Okay, so let's take a look at your portfolio slice here. Also, once again, more focused on the growth. So as I mentioned before, is this a growth or is it capital appreciation or is it cash flow? The companies in there are fine, right? Target is great, Netflix is great, T-Mobile is great. Like there's Tyson Foods is a really good dividend company as well. Amazon, Beyond Meat, like these are absolutely fine companies. Let's take a look at your REITs. You got DOC, Realty Income, WPC. Okay, this is really good. This is a really good one. This has a 5.5 dividend yield. These are the type of dividend companies that you want in your portfolio. WPC is really, really good. It's a diversified REIT. Another one that I really like for cash flow is ticker symbol GOOD, G-O-O-D. It's not a growth company, but it pays like an 8% dividend yield and it's paying it monthly. A really, really great REIT. One that I have in my portfolio. I own WPC and I own GOOD in my REIT portfolio. So if you're focusing on cash flow, I personally think you could bump up REITs to 20, maybe 25% if you wanted to, if it was in a taxable account and you diversified the holdings for cash flow, because you're going to get a much higher dividend yield with the REITs on average than other companies, for example. All right, now let's take a look at your next slice with MJ. MJ is your Mary Jane. Okay, this is your cannabis. Okay, yeah, I mean, with this kind of portfolio, especially with this slice and your other tech slices, this is a very volatile portfolio. But given your time horizon, maybe that's the right approach. I personally, I don't invest in that type of way because obviously my time horizon is different, but I'm really focused on cash flow, building up a portfolio that cash flows and not really one that's hoping for exponential growth in a very short period of time. Let's take a look at your ETFs. You got VOO, VTI, and you got your ARK ETFs in here. Yeah, I think these are fine. These are great growth ETFs. These are great sustainable ETFs, market, broad-based, low-fee ETFs. I think these are fine. And your foreign companies, what do you got in here? Okay. Alibaba, Canadian Solar. Well, Riz, thank you so much again for sending over your portfolio. When I think about your portfolio and what you're trying to accomplish, grow the portfolio exponentially with a lot of the holdings that you have in here. I don't have a crystal ball. I don't know what the market is going to do in the next 3 to 5 years. A lot of the companies that you have in here are growth companies. Like you have Lemonade, you have Beyond Meat, you have Neo. They're very different than like Kellogg's or Coca-Cola. If you have a strategy in place where you're saying, okay, I'm going to invest heavily into growth for the next 3 years, and then I'm going to sell out of them and reposition into maybe higher dividend paying companies like the REITs that we talked about. I think that approach can work very well. Timing does play a role in that, but the best suggestion that I can give you is focus on a clear strategy. Is this for appreciation or is this for cash flow? Because they are very, very different. And with your time horizon, it can play a significant role. And as I mentioned, make sure that you're doing your due diligence and your research on the different types of accounts, leveraging those tax sheltered accounts that are available to you. Once again, Riz, thank you so much for sending over your portfolio. Thanks for watching, everybody. I hope you all have a great week. Stay safe, and I'll catch you in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.